Breaking news. COMEX gold has surpassed $4,530. What's happening? Just now, the United States personally intervened to save the market, something not done in over 20 years. The 30-year US Treasury yield plummeted instantly, and the real trigger was someone personally buying US Treasuries. Let's first see who took action. The US Treasury Department. This is the biggest player in the global bond market. The last time such regular buybacks of US Treasury bonds occurred was from 2000 to 2002, when the US had a fiscal surplus and bought back bonds to pay less interest. This time, however, is completely the opposite. With already high debt, they are spending money to buy bonds. The market generally interprets this as the US Treasury stepping in to share the burden with the Federal Reserve, signaling a once in 20 years intervention to support long-term bond rates. How exactly is this being done? The US Treasury Department just announced an expansion of the long-term nominal Treasury bond buyback scale, doubling the maximum per transaction from $2 billion to at least $4 billion, focusing on buying ultra-long-term Treasury bonds of 10 to 20 years and 20 to 30 years. These two maturities are the core of long-term interest rates, directly determining global long-term financing costs. Just announced, the effect was immediate. The 30-year US Treasury yield had surged to 5.337% yesterday, reaching a new high since 2007. As soon as the news came out, it plunged directly to 5.192%, and the 10-year yield fell to 4.639%. So why did gold immediately rebound significantly? The yield on US Treasury bonds is the pricing anchor for global assets. When it falls, the opportunity cost of holding gold decreases, leading more funds to flow into gold. As a result, New York gold surged, breaking through $4,530 per ounce. The futures of the three major US stock indices also collectively turned upward, with the Nasdaq turning positive. In the past 24 hours, US stocks, A-shares, and Korean stocks have all been falling. The root cause is the collective rise in long-term bond yields in developed countries, reaching the highest levels in over 10 years. Now that the US Treasury has taken action, it is equivalent to announcing to the market that there is good news for the stock markets and commodities, especially gold, which are all supported in the short term. So, what is the outlook for gold? My inclination is that in the short term, it will be relatively strong. If long-term bond yields are continuously suppressed, gold's strength will have inertia. But it must be made clear that this buyback scale is actually not comparable to the Federal Reserve, and it serves more as a morale booster. What truly determines the fate of gold and tech stocks is whether long-term rates can genuinely come down. If relying solely on buybacks to suppress rates, with inflation and debt expectations unchanged, volatility may increase after a surge. Do you think this wave of gold will stabilize at 4,500 or surge and fall back? Comment stabilize or fall back to see whose prediction is more accurate. Follow me, I'm Gold.